We're good? We're live?
Yeah, all good.
Beautiful. Hey everybody, thanks a lot for tuning in and being a part of tonight's webinar. If I can just do a quick IT check, make sure everybody can hear us and is here. If you can, just maybe flick us a little message in the message box to let us know that you can hear us loud and clear. Can't seem to find anyone's messages, so hello. There's no, there's nothing coming in. Oh, here we go. Oh, here we go. Cool.
Right.
At a different box open. Awesome. Cool. Just going to make this. Oh, here we go. Got it all. There's always something that happens. There's always something, Mike. Just little, but everyone can hear us. So
technology.
That's it. So thanks a lot for tuning in. Thanks, Luke, for the spur on for my haircut. So look, tonight I want to talk about something really important. I've got Mike here. Mike, maybe you can give yourself a little bit of an introduction in a moment. We'll get on to the slide, but today I'm going to be talking about how to build a property portfolio inside a super fund. Now, just for the audience, like there's a fair few people here that are investors that have got super funds already and have financial advisors that they use. But just as a bit of an intro, so we have, so I don't know what's happening with the screen. It's video camera's a bit blurry. So we have William, which works alongside Mike and Nimal as well. So Mike's just come on today to talk about, his background and building a super fund, self-managed super fund. So today we're going to talk about the scam of the super system and how to protect yourself and a few examples and some really cool stuff. So I'm really excited to talk to everyone today about that and to have you on. So Mike, maybe if you want to give a little bit of a background on yourself and what you're doing and how you help people and all that sort of stuff.
Yeah, thanks, and thanks for the opportunity, Nathan. Been involved in the financial services arena for over 30 years, have built a specific advice consultancy around all the risks associated with investing either outside or inside super, in particular around self-managed super fund. So what we try to do is ensure people are fully aware of what they're getting themselves into and make sure as best we can we provide strategies and their process to ensure that they have every chance of success. There doesn't appear to me to be a great, I suppose, opportunity to get things wrong by being ignorant or not getting the right advice. So coming on board and working with your clients is an opportunity for us to ensure that they have the greatest level of success and putting those foundations that we talk about and you talk about as far as looking forward to building a portfolio, but making sure that you do it in such a way that nothing happens along the way to unravel that.
I see so many people that come in and they message me on social channels. Sometimes I see messages, sometimes I don't. I don't manage the social media platforms for various businesses, but I do see a lot of the questions that come through occasionally. And a lot of them are like, hey, Birchie, where should I buy? Where's a hot deal? What should I do as a hot deal? And most people look at it just, making a quick buck or doing a deal or a transaction or, hoping to buy a property because potentially and maybe one day it'll go up in value. You need to have solid foundations, which I always talk about. The long plan, like for me today, I'm not planning for, most people are planning for their weekend and shit like that, or the next holiday. They spend more time planning the holiday or what they're doing for Christmas or whatever.
Yeah, that's absolutely right.
Their life. So I'm thinking in my life, like we'll just talk about all the motels. I've stuck a whole bowl on the wall, just bought another 6 motels, which is really cool. But I'm planning for like generation after generation, right? That's the plan. And I think that, we need to look at investing as not just, let's buy a couple of properties and make a few bucks, because anyone can make a few bucks, but it's like, what's the opportunity cost? What is the end game? Like like if you're 20, you've got, 3 times your life to live until you're going to retire. if you're 40, right, you still got another 40, 60 years ahead, hopefully, touch wood. And what are you planning for right at the moment, and how can you utilize what you've got to get to where you want to be? And I think when we look at super, a lot of people just quite often go, oh, we'll just leave it for later, or it's in that super fund, and they don't know exactly where their position's at. And
I think one of the things from a planning point of view that's really important, Nathan, is we help clients understand potentially where they are now, and quite frankly where they need to be. Once you understand where you need to be, you can actually work back and put together with yourself a program, a portfolio that will get them to where they want to be. But a lot of people underestimate the opportunity. They don't actually see themselves growing a large portfolio and having that financial freedom. And I think that's using the tools at their disposal, and certainly getting their superannuation to work a lot more effectively for them is a big one.
That takes me on to my favourite.
Yes.
My favourite one. So a couple of things. Like I've said to everybody a lot over the years as my non-financial advisor that I give to everybody, and it's just like we should have put a little disclaimer out there. None of the stuff we're going to talk about today is financial advice. Mike is a financial advisor. He can give you that advice, but it is tailored specifically to what you need to achieve. The things that we're going to be talking about are very generic, but very specific to one situation if they were to take actions towards a specific situation that could occur. So there will be lots of examples of situations today that we'll be talking about. But for me, I always revert back to Wolf of Wall Street, that movie, right? The first half of the movie was like pretty fun, and then he saw the bad stuff happen. Bad stuff happened from the first 5 minutes, I think, from every ages, right? But looking at your super, the people don't question, right? They just have this belief that, like, okay, the TV will not lie to me. The actors will not lie to me. My politicians will serve me perfectly, right? The schooling system is the best. Trust in the TV.
That's it.
And we have this belief where you go to a 12-year indoctrination camp, become a good tax slave, and spend 40 years tied to chasing pieces of plastic with dead criminals printed on that we all know as dollars and money. But where people just go, oh, it's in my super fund. Like, the question I ask is like, what is your super fund, right? Like, people don't even question. People don't. Yeah. When was the last time you stopped and go, what is my super, right? Your super is meant to cover you for when you retire, but people never even look at that, right? This is the biggest thing you're working towards, so you can have those years off. Like, if you're working for 40 years and you go and retire for 30, and you suddenly got no money, you should be working towards your future. And people stupidly go, oh, well, I don't know. So I always ask people the question, and if they can't answer this question, they've got some serious fucking issues. And I don't think I've ever mentioned it to you, right? So the first one is who is looking after your super, right? So if you've got a couple of $100,000 in your super, it could be 100,000, it could be 500,000, it could be 200,000. Like, people literally have hundreds of thousands, quarters of a million, $500,000 in their super fund, and they don't know who has it, where their money is, or what it's invested into. So if you don't know where your super is all located, you've got an issue. If you don't know what your super fund provider invests your money in, you've got an issue. If you don't know the person making the decisions, then you've got an issue. So the question I ask, people might have 100 grand in the super or 200, and I go, what's invested into it? They go, oh, I think it's in shares. Well, is it in shares? Tell me about those shares. What shares are they? Right? Are they like wherever, right?
And the information's there for people to find out. But just by being sent out a annual statement each year, they meet their obligations to provide you with the advice. The biggest question that for me is that what people have to understand when you and your money goes into one of the retail or industry funds, they employ a fund manager based on what they suggest should be your average returns in the various types of funds they invest in. But they don't have the same time frame, and this is the biggest fundamental issue. People don't get advice when they're in that pre-retirement phase.
Yeah.
And what happens is if the share market, or we have a worldwide pandemic, that means that the financial markets crap themselves.
Yeah.
And it's the day before you retire, and you're relying on that extra 20% that fund has now lost to fund your retirement. So the fund manager's not there to look after your money in particular. Self-managed super fund allows you the privilege of understanding exactly what you need to do in your timeframes to get the result, and then safeguard that result.
Yeah.
You can't do that in a retail or industry fund.
And that's why I ask people, like, you know, in February 2020, what did your super fund do to protect yourself, right? How much did your super fund go down? So I was talking to someone the other day, and they're in the process of setting up a self-managed super fund, and this person said to me that that it had, I think it was like 160 like in January last year. It went down to 130, and then it's back at 180. And I was like, hang on a second, you put in like 20 grand worth of contributions.
So it's got
before the crash,
that's right,
you've done nothing. But if you look at everything else, like the stock market's gone up, everything's gone up in value, everything's been inflated. So will the same 100 grand or 200 grand that you got in your super fund last year buy you the same things that for 100 grand a day? If you've still got 100 grand in there, you've just lost half your purchasing power. And a lot of people don't realize that, like, you know, when they go to seek what they've got in their super fund, they're greeted with the fact that they've got some form of a derivative or some financial instrument that is not an actual share and it's not a property. What a lot of people don't realize is that if let's say that a big shopping at Westfield wants to go out and add an extra story to their shopping centre, they don't go to Combank and say, oh, can we get a 95% LVR on the valuation? They go in, they go, well, let's raise a bond or some sort of financial instrument, and then they grab it out of the super fund. In 2018, just as things were starting to go a bit weird and the markets were crashing, a lot of people weren't aware that back when Turnbull was the Prime Minister, he quickly went to the US to meet with Trump. And he bequeathed like $1 trillion worth of Australian super funds to keeping as a financial instrument, as a derivative, to back the government, because Trump didn't want to do a deal which would involve doing a deal with the Democrats, where he shut off, a lot of people may or may not remember when he locked down government and said that he will not be paying essential services and all that sort of stuff. And he needed to borrow get some liquidity. So he went to Australian super funds and did a deal and then made up some sort of package, and it would be classed as like some form of infrastructure package, and then it would be sent over there and whatnot. But what is happening to your super, right? And like we've seen these Ponzi schemes in Wolf of Wall Street and all that sort of stuff, your funds, what is actually happening to them? So someone just asked a question and says, do retail super funds move your super to a low risk allocation as you approach retirement?
No, that's a very good question, and that's, I suppose, part of the point that I was making. And unless you've got an advisor or you're smart enough to understand that you need to secure the funds you've got in that pre-retirement phase and don't have them exposed to what Nathan's just talking about. That's why, again, having a self-managed super fund, I've got a number of clients that set up funds and roll their money into cash just prior to the recent downturn. They were laughing because they secured their superannuation monies. They've since gone on to buy properties, and as a result, they're in control of their assets. Another thing that people may not understand, Nathan, is that self-managed super fund makes up the largest by way of volume of assets under management of all the superannuation environments that we have, including retail funds, including industry funds. Industry funds by volume have by far the largest number of members. But that's because you've got your 18-year-olds and 20-year-olds that are just starting out, that have only got a small contribution going in, and they've got to go somewhere. But when people realise that once they've got $150, $200, $400,000, it's worthwhile taking notice and getting control. And that's what we're really talking about tonight, getting control of your money.
We've got 60, 70,000 people in our community, and over the years I've been blessed by like chatting to and having conversations. I think just from map sessions, myself, and I had an ex-business partner, Daniel, back in the day, and some people know him, some people don't. He used to do map sessions with people, and over the years, over the last 12 years, we've done probably 10, 11, 12,000 map sessions where we've met people and spoken to them. And the people where I've seen where all the smart money goes, I can see people's positions. The smart money has always gone into a self-managed super fund because people can have their own control.
Correct.
If you think that the market's going to shit itself tomorrow, you can sell off your stock. You can buy Bitcoin, you can buy crypto, you can buy gold, you can buy silver, you can buy classic cars, but not to use. There's lots of disclaimers.
Yes.
Like to talk about that. You can invest into whatever. It doesn't mean you need to pull out money from your super and buy a property. You can buy any other sort of performing asset, and you can be very smart about how you actually structure that. So, not to spill the beans and give any spoiler alerts, but if someone was to have a business. Let's say that they've got a business that they operate from an office or a shop or something like that, or a mechanic's workshop. You could technically purchase a property inside your super fund, and that could be your place of work. So people might say, I can't afford my business premises, and there's different strategies around that.
Yeah, well, we're actually doing that for one of OnePart's clients right now, who has a commercial property with debt on it, but equity. And we're restructuring that, and he's buying the commercial property and putting that in his super fund, releasing the equity, and as a result of that, he gets to pay off his non-deductible home loan, but he sets up an ongoing income stream for him and his wife in retirement that would be potentially tax-free because it's now in superannuation. And that's one of the other things that people need to understand. There's a lot of benefits by making sure that you think in terms that superannuation is an environment that allows you to generate tax-free income in retirement. So making sure that you max out your opportunity in superannuation is very important.
That actually takes us to the next slide. I saw why have a self-managed super fund, so why build it. So maybe if you can let some of the viewers know, Mike,
sure.
Got you, like, what are some of the benefits of building a self-managed super fund, and how can they help you?
Look, and I suppose the caveat up front, it doesn't apply to everyone, but everyone should look at it. Does that make sense?
Yeah.
And it may be that it doesn't apply to you right now, but simply because of the numbers just don't make sense right now. But certainly educate yourself and understand why so many Australians, when their super is at a level that they really need to take notice of it and manage it, why so many of them are gravitating. There's around about 25 to 30,000 new self-managed super funds being set up each year. And that's not by coincidence. That's because people are getting a better result. Very simply.
Realising that it's a...
Well, by you having control. There are dangers, of course, and we will talk about that a little bit later as far as the risks and what you need to understand. But the main reason why superannuation is controlled under an act of Parliament, which is called the Superannuation Industry Supervisions Act. So when the concept or the thought back in the Keating government was to try and generate a lot more housing, building and generate the economy, one of the things they discussed was using superannuation, people's superannuation money to do that. The problem is, of course, property typically is a process where you have a certain amount of money, then you need to borrow for the balance. So as a consequence of that, to change that act of Parliament would have been way too difficult. So what they did is they created new rules that sit under the tax office that don't sit under. So for some of you may know this, but others that don't, the self-managed super fund regime is administered by the tax office, not by ASIC. As a result, they were able to introduce what they call limited recourse borrowing arrangements. That limited recourse borrowing arrangements means that you can buy a single acquirable asset through your super and you can borrow. The borrowing is held outside of super through a particular structure that needs to be set up called a bear trust. And so it's somewhat complicated, it's somewhat convoluted, but again, one of the things that we do in working with your clients is we hold your hand right through that whole process, make sure things are done from a correct point of view. And the real benefit is At the moment, you buy property, and many of you have got existing properties through Nathan and his team. You're buying those properties outside of super. Then, if it's an investment, then you are going to potentially look at some sort of capital gain on that property, and maybe have to pay tax.
Yeah.
Within superannuation, once you reach preservation age, and for most people it's around age 60, it means that you can technically retire. If you retire, then you're not paying any tax, income tax. Therefore, the calculation of capital gains tax essentially means you don't pay capital gains tax. So, one, leverage in self-managed super fund that you can't get in a normal super fund. Normal super funds can't borrow, and they can't borrow because legislatively it's against the rules. They can't do it. So, by you taking your $200,000 or $400,000 balance and leveraging that into $400,000 or $1 million worth of property, you're getting capital growth on the million and the yield on the million. That's very simply why it works.
Yeah, and I guess that is where a lot of people don't look at it. So, like, we've got a few examples. I noticed here that Vishal had asked, "Hi guys, wondering how much super you need to start and purchase an investment property. Would 150,000 plus do, or do you need more?" We actually got the next couple of slides. We're going to dedicate to that, so keep watching on that. But a lot of people, what I find, don't realise, like, people might come to us and they're like, "Well, I've bought 10 properties and I don't service," but they may be able to buy 2 properties in their super or 3 properties in their super, because you can get loans against them there, which is non-recourse loans. So if someone, maybe you can tell us a little bit about this, Mike, if someone was to buy a property and they want to go bankrupt, would that property get removed? And if they couldn't afford that property and the property blew up and got repossessed or whatever, would that person get affected by it? Well,
no, the property through your self-managed super fund is by nature a limited recourse. What that means is that the lender can only lend against that particular asset. It doesn't affect your personal borrowings, doesn't affect your personal asset position. The downside is that if you were to be declared bankrupt, and that's a good point, there are lots of rules around all of this, and some of them mean that you are precluded from doing certain things.
Yeah.
If that was to happen, then you can't be a director.
Yeah.
If you can't be a director, you can't be a director of the trustee company.
Yeah.
But by natural attrition, if
Yeah.
you can't be a trustee, or you can't. However, what you may find is that if you operate with a partner and they're a director of that company, the self-managed super fund could continue on.
Yeah.
So there are ways to manage those risks, and what we do from an advice point of view is assist in making sure we tick all those boxes to manage those risks. But I've never had that question before, Nathan. That was a very good one.
Lots of funny questions come from me.
Yeah,
but most importantly is to leverage. Like, a lot of people, you can't leverage inside your industry super fund. So looking at a couple of examples here. Some people, you could have 150 grand in your super fund, which is a question that Vishal asked beforehand. Here's an example, and maybe if, Mike, you've got the mouse here, you can just screen to what everyone sees. If you can share with them what.
So this is a calculator that we built specifically to be able to assist our clients really understand the cash flow, because quite frankly, as I've said to Nathan before, there's no point doing this if it's not going to give you a better result than what you're currently doing in your current industry or retail fund. So what we need to be able to do is demonstrate to people that we've taken all the costs involved. Our variables and assumptions are based on information that's readily available out there in the marketplace. So if we work through this, and this would...
I think they put the wrong slide on here, actually. Strangely enough, it's got the $100,000 deposit, not the $60,000 deposit. So if you were to put it in the top here, just before we get started, guys, this here says 200 grand purchase price. If you were to buy, you'd get your 150 grand, crack it open, you'd have 150 grand. If you were to buy a property for 200 grand and put down a 30% deposit, this figure here would be $60,000. So there was 2 versions of this. This one is the one that's gone on here. So the numbers should naturally look better, but we've got other examples.
Absolutely, Nathan. And the reason that we have this calculator, this isn't a live version, but we can tailor the result to your client. what's in the best interest of them to get the best result. But even in this case, what we're looking at is an investment growth and yield of these numbers, monthly repayments, stamp duty, conveyancing fees. So all the costs are in there. One of the things we like to see is that there's at least 1 year of cost buffer. And what that allows is if anything happens and you need to exit, then you're not forced to fire sale. You've got time over that 12 months to look at things. But if we look at the numbers, we're looking at just one. So this would be an individual with on a $70,000 income having a $7,000 contribution going into super. Why is it 7,000? Well, 1st of July this year, SG contributions go up to 10%. So total investment income and contributions of 21,000 a year coming in. Loan repayments, we allocate an amount for insurance to make sure that if anything does go wrong, you're taken care of. Property costs, which is all of your operating costs of running the property, and administration. That administration is very important because we do not want the fund to be non-compliant. There's over 90 trustee responsibilities and you really need to outsource that. We'd highly recommend that. So you've got 21 grand coming in, 18,000 going out. And so we then extrapolate those numbers out for you with the growth and yield. So you'll see on the next slide, the opening balance, net flows, setup cost, deposit, balance. And if I take all through that from a cash flow point of view, what you're seeing here, cash balance growing, property valuation, mortgage reducing slightly, but we've taken a $150,000 balance and turned that into nearly $600,000 worth of superannuation net balance. And what that represents is a 19% year in, year out increase in the value of your fund. That's why you do it.
Yeah. And one thing we haven't seen in here and factored in is that if we're talking about you've got a cash balance of 46,000 that's going up year after year, we haven't factored in that
year four, you buy another property.
Correct. So if we've got 60 grand in there that we can go buy a secondary property, then you'd have 2 properties going up. So, and we've got another slide that'll explain that a little bit further. Yep. But you technically turn your 150 grand position into a 582,000. We've got a little slide here that would be a good comparison. So this here is a slide regarding traditional super, which would be in your industry super fund, yep, versus a self-managed super fund. So the last slide there is very, very conservative based on the fact that
it's only one property.
One property and it's only doubled to 400. If you bought 2 properties and you could have maybe bought 2 or 3 properties in year 10, every 5 years going to buy yourself a second property or whatever, you could have, you know, tripled the sort of net figure at the end. So
the next slide up there is directly from the Money Smart ATO website. So we thought we'd grab that as a comparison. And the reason it's age 50 is that we wanted to use that 15-year window to see where the result would be.
We'd only factored that last example on a 15-year time frame, whereas this, yeah. So it's
and depending, and again, that's why getting a specific advice and calculation for your own circumstances is important. But this is general advice. You can go onto the Money Smart website through the ATO, and you can plug your numbers in there and your age, and it'll tell you what you think the fund is going to be worth.
So this is for all the people out there that are working on an investment return of 5% per annum.
Correct.
This is a 5% return on the 150 grand with the contribution coming in every year at the same figure. You would end up with a net figure which would be 241,000. So the difference between 582 and 241 would be 341,000 roughly. Yeah,
correct.
Calculation.
So, and the reason the numbers are slightly different, we've got a higher yield and higher growth, but that's because Nathan can go out and find you those properties are going to perform like that. This is based on a fund performance that we looked up. One of the largest industry funds, retail funds out there is Sun Super, and they have a conservative investment profile that's only generating over the last 5 years a 5% return. And that's similar in volatility to you having a property.
Yeah. But the one thing that always gets me with these super funds and stuff like that is that nothing has been factored in on inflation, right? As we said beforehand, like the power of inflation is losing. Like by the time it's 15 years time, who cares about having 150 grand and getting 241 where you've got 90 grand extra? You've just paid that 90 grand basically into your super fund. It's all gone into fees and expenses that you don't see. In running them.
And that's a great point, Nathan. A lot of people, when they receive their annual statements, or that they don't really take much notice of the fees. A lot of people have multiple super funds. They don't consolidate. That's the very first thing you should do, not have multiple retail and industry funds out there, because you're paying fees in each of them. But if you look down the bottom here, over that 15-year period, you paid $31,000 in fees.
Yeah.
And people, and that's a direct cost. So when we look at
$2,000. Sorry, Mike. A lot of people say that the cost of setting up a self-managed super fund, there's costs and all that sort of stuff. But if you're paying 30 grand over 15 years, that's 2 grand a year you're paying anyway, just for the privilege of having a super fund.
Absolutely. So yes, there is a definite cost up front to set up the super fund, and most of our clients that we talk to, we'll show them that they're probably going to have a zero or less than zero return in that first 12 months.
Yeah.
But when you extrapolate those upfront costs over a 15-year period, they pale into insignificance compared to your industry fund costs.
Yeah. If someone had 200 grand, so this example that we've used here, Mike, if you want to throw it over to you.
So basically what we've done is simply said if you had an extra 50 grand in your super, but there was two of you, husband and wife potentially, or partner, so we've doubled the contributions, as you will see here, and all we've done is doubled the amount of the purchase price, being two properties for $200,000.
And the deposit's based on a 30% deposit of 120.
Correct.
And it's closing costs of. Yeah.
So the stamp duty number's gone up, for example, the bank fees, because you've got two properties. So we've allowed for all of that, and again, loan repayments, insurance costs, property costs have gone up because there's two properties. Administration's the same, and we look at a significant result. We're talking in 15 years' time, net fund balance of $1.4 million, and annual average growth, which includes the growth of the fund, it includes the rental income, it also includes your contributions. Your fund's increasing by 40% a year. That's the sort of outcome you need with your super. If you go back and look at your current industry funds and current super funds that you've got, take away or include your contributions in that and do the math, they're not increasing at that rate. Yeah. The significant thing here is the fact that Nathan will find you the property that's going to work for you in your super fund.
Yeah, and the thing that that we haven't gone into in this at all, right? This is how conservative Mike has been with the figures that we've calculated, is that the cash balance, like
correct,
these cash balances, one, the mortgage is down to 199,000, but your cash balance is 565,000. We haven't even factored in the fact that
you could buy another property,
another 1, 2, 3, 4, or 5 properties in your super fund at this point. So you could technically have, instead of 2 properties, you could have like 5, and that number will blow out to, could be $2, $3, $4 million in there.
So you can imagine the yield on that. You imagine the rental income that you would receive. We're showing here $28,000. Just double that with another 2 properties, and you've now got a non-taxable pension income in your super fund. Yeah. That most people would live off 60 grand a year.
Yeah.
And that's what you're trying to do anyway. You're trying to do that outside super before you retire. This is a great strategy because of the tax advantage you get in super.
So if you could get 4 properties in your super fund,
120 grand a year.
Yeah. So no, that's 2. Yeah, so 4. Which we've got actually example.
We've got an example of that.
But just whilst we're on this slide, I'm going to go back to the previous slide. if we look at this one, this was having 150 grand super balance, right, and contributing 7 grand a year, you'd end up with 241. But here, if you were to have a 200 grand super, which is only an extra 50 grand, not much, but you had the 2 people contributing to it, so it could be a spouse, a partner, or whatever, then you would be in a position where where the number is 1.69 million. These are just.
And again, you can go on the Money Spot and do that calculation yourself based on your current circumstances. And then what we do is we can compare that, and we can provide you with this calculation specific to your circumstance.
Let's go on to the fun one, Mike.
On the fun one. This one got us pretty excited.
Some people have more super than others do. Mike here has put in a really conservative figures here, buying a property value of
250. 250 for 4 properties.
4 times 250k properties, or 2 at 200 and 2 at 300, whatever it works out to be. You can play around with those numbers. But
so again, a 30% deposit, borrowing. We're looking at monthly repayments. We're looking at stamp duty, obviously higher bank fees and conveyancing, because we're talking 4 properties, 18,000. So we've said, okay, well, maybe someone has got that a little bit more in super are probably earning a little bit more. So, they're putting in 9 grand as contributions in, and that's not uncommon. Most of my clients are sitting around, as husband and wife, somewhere between the 15 to 20k of contributions. That's indexed, of course. So you got a total annual flows of 89 in, 75 out. However, what we've got is a result in 15 years of net $3.5 million. What's exciting about that is you can't actually have 3.5. The maximum you can have is 3.2 at the moment. That is being increased. As individuals, you're allowed to have $1.6 million each. And that's one of the things that we also provide advice on, Nathan, is making sure we equalise the partners' superannuation accounts as we go along. There's no point having someone who's earning 300 grand a year putting 25 in, and another partner not putting any in, because they can only still have 1.6. So what we do is we then start making contributions to the spouse to make sure we equalise and they can get that 1.6 each.
What would be the situation if it goes over? What happens?
You just pay a little bit more tax.
Oh, okay.
That's all.
Okay.
Look, it's not a big. It's what's called excess contributions or excess benefits.
They love functions, don't they?
And in this case, if you were retiring in 15 years' time, how we would deal with that is you would simply take a lump sum out, and you made the point earlier that the beauty of the superannuation environment like this, when you retire and you're not paying any tax, you take the money out tax-free. If you've got any personal debt because of your other property portfolio, you can use 100% of those funds to go and extinguish that debt. By doing that, you'd reduce that back to your 3.2, and you'd be under the cap, and you don't have any excess benefits.
So a lot of people, when they come to me, I would never give financial advice because I'm not a financial advisor, but I do love having comical conversations with people and talking about fun strategies and random thoughts, like as if we're drunk down at the pub having a chat.
Sure.
And I often say to people, the biggest thing that's untapped, look at their position and always send them over to be looked at, is, with their super fund, they might be wanting to buy 15, 20 properties, right?
Yeah.
Let's say that someone wants to retire and they want, say, 100 grand a year. 100 grand a year is 2 grand a week. 2 grand a week, average rent of $300 a week. You need about 7 properties to retire. People will go out and buy 10, 12, 15 properties, and the cash flow of those properties will go up. If they're 200 grand a piece and they're positive cash flow, 50, 100, 150 bucks, let's just call it $100 a week times 15 properties, so $1,500 a week, they can retire. But if you've got 15 properties at 200 grand, and let's say you've got $2 million worth of debt, how do you pay that off in retirement and have a really good retirement?
Yes.
Like this here, being able to have an alternate sort of property portfolio, you could get that point, build it up to when you're 65, sell it, liquidate, take that cash, pay off your debt. Would that be fair to say?
Look, it's certainly a number of strategies, but I think the key to this as we go along is to then refine the individual strategy that suits each client.
Yeah.
You can't have a strategy unless you've got the means to implement it.
Yeah.
So if you don't have the numbers that we're talking about here inside super, you can't do that.
Yeah.
So it's very important to have multiple strategies. It's very important to have the best one that works for you. And that's what getting advice is all about. Sitting down and you don't arrive at that point and go, oh, this is what I'm going to do.
Yeah.
What you really need to do is start adopting principles around this that get you to your best position.
Yeah.
And again, that's what we do from an advice point of view, ensure people have got the best plan that works for them.
And I know that if this was one of your clients, that this figure here, these figures here would not, be the case. Because
this was just an example of showing 400K now, you can buy $1 million worth of property. This is what it would look like.
Yeah. I was actually talking to someone last night. I had a map session, and they had that sort of figure. So if they're watching, it'd be really good for them to see. They know who they were, the lovely couple. But yeah, that's an example specifically. Like lots of people do fit into all those scenarios. That's why I thought we'd share that.
And if I could probably highlight where I suppose you massage to individuals as far as their circumstances, it comes back to certain things. How long before you retire?
Yeah.
What are your retirement goals and objectives?
Yeah.
All of those types of things. So for some people, a property portfolio of that magnitude with the debt paid off through the super may be the thing that they want.
Yeah.
Because you can then draw that down tax-free and live quite comfortably.
Yeah.
However, if they're building up a portfolio outside of super, where do you get the money to pay that debt at retirement? So you've got 10 properties outside, and you've got maybe I've heard other strategists talk in terms of sacrificial properties.
Yeah.
So you look at the ones that capital gain, sell some down, but you get to a point where you can either retire early.
Yeah.
You can.
If they're outside the super fund.
Correct. And look, like I said, one of the best things about the property inside super is the potential to pay no capital gains tax.
Yeah.
That's a real big one. Leverage, you get yield and growth, and you get no tax.
Yeah.
You got to be in it.
That's it.
Simply got to be in it.
On that note, I've got lots of questions that are coming through, so it may take a few questions, but obviously a lot of people will want to know how to set up a self-managed super fund. But I've got
maybe we just run through that quickly and we get to the questions.
Okay, yeah, sure. Yeah. So how would someone set up a self-managed super fund? What's involved?
One of the things and the questions that I get a lot is, I can go on the internet and I can set up a self-managed super fund for $600. The answer to that is yes, you can. The problem is it probably won't be the right type. You won't have the right trust deed. It won't allow you to borrow. You won't have considered the fact that whether you need to be an individual or corporate trustee. And these are all affect the outcome when things change or things go wrong. So it's very important to understand that you get the right advice to get the right structure. So setting up a fund from our perspective is understanding that if you are looking at property, then there are certain requirements need you have, which will be the super fund, a trustee company for the investment, because you can't hold the property inside the super while there's borrowings. So you need a thing called a bare trust. You need to set that up. You then need limited recourse borrowing arrangement documentation. Now, we through our OnePath friends of B.Invested, they do all of that for you. They'll set it all up. All of the costs of doing it can come from the super fund, and we've included those costs in our cash flows that we showed you earlier. So it is complicated. There's rollovers have to be done. We need to ensure that you don't lose your insurance that you've got in your current super.
Yeah.
So we, again, take care of all of that. There are lots of moving parts, but we hold your hand and we take you through that whole process. Okay.
Awesome. And how long does it take? Like, is it like, yeah?
Currently, it should take no more than 4 to 6 weeks from start to finish.
Yeah. From
getting the advice for you making the decision, we order the fund, get all the documentation, it gets all executed. Look, it's similar to buying a property outside of super.
Yeah.
There is a similar process of documentation.
It's much more complicated when it comes to the property front from the financing and that. Like a lot of people always try and let them know. Like I often have, like, 'cause some people may or may not know, I've got a dozen odd brokers out there on the floor, and people will be like, "Oh, I've been using the broker for years, and they're really shit and slow right now." It's like, "Oh, tell me what's wrong." It's like, "Oh, well, you know, all the last 5 properties were great, but now it's taken forever. Like it's you know, whatever." Banks are the worst at the moment anyway, but throwing super funds on top, they're very slow, and everything's done manually when it comes to the paperwork. So it is a bit of a.
And look, there are certain rules around, and we advise and make sure people understand the rules. There's only certain properties that qualify to be purchased for self-managed super fund.
Yep.
And as a result, again, from a lender's point of view, because they can only take that asset as the security,
Yeah.
then they've got to make sure that they're happy with that property,
Yeah.
as well. So yes, it's a little bit more complicated. Yes, it's a little bit more time involved, but I'm happy to spend that time when you get that sort of result.
Yeah, exactly. And a lot of financial planners and advisors that I've experienced over the years, I've just seen so many of them that have come in and whatnot. The level of like advice that they get is elementary. Like it's just, you know, something out there that I've experienced. So in financial planning space, you know, your parents would have said, don't trust the insurance salesperson. To be an insurance salesperson, you must be a financial advisor or financial planner. And there's a lot of like just shit advice out there, like that's just being calling it for what it is. A lot of people there's a lot of money. Like Mike could earn a lot more money if he was out there selling funds and like the share portfolios and all the products to go inside it.
It's a good point, Nathan. What people on the webinar need to understand is that I don't give investment advice.
Yeah.
What I do is I make sure you understand all of the risks involved and the outcomes that you're going to get if you choose to do this yourself.
Yeah.
I'm not going to tell you should go into a managed fund or a share portfolio. And the reason for that is I'm a property advocate. I invest in property through self-managed super funds myself, and I understand how it works. And I've never understood I have understood why the financial planning industry generally won't advise you on property, and that's because it's not a regulated product. As a result, they can't make any money off it.
Just why they say Bitcoin's bad and gold and silver's bad.
It's not a regulated product.
Yeah.
So a financial planner in a general advice, a full advice arrangement that would give you a so-called diversified investment portfolio, you'll find there's no direct property in that. They certainly don't advise people to set up self-managed super funds for this purpose. They tend to set those up when people are in retirement, and they then have a portfolio that they live off at that point. I'd rather have an unencumbered property generating rental yields of between 5 and 10% because it works. So my business is about the risk of you doing this. I'll make sure you understand that, and therefore you go forward with certainty. That's what we do.
So put it in layman's terms to everybody is Mike thinks you should be your own financial advisor.
Correct.
And gives you all the skills and the tools and the resources to be able to make educated decisions on your own front to be able to,
look, people are on this webinar here because they're interested in property.
Yeah.
As a result, here's a method for you to increase your property portfolio.
Yeah. Cool. Lots of questions coming in through. We're sort of halfway through the slide deck here. We'll answer some of the questions just for people. People should need to stop listening to Koshi from the Sunrise. That is the worst advice one could ever take. When I was a kid, there was a Muppet on TV, and his name was Agra. This guy, I'd rather watch Agra than that bloke.
Yeah.
John, do retail super funds move your super into low risk allocation as you approach retirement? We've already
I think we've all dealt with that. No, they don't. It's something that you have to do yourself. And the reason for that is, again, they don't give advice. The only way to get advice around what your strategy should be around that is to speak to me.
So we know what we need to do. Hi guys, I was wondering how much super do you need to start a purchasing an investment property? Would 150 grand plus be enough?
Well, we showed that, you know, and yes, yes, it is. Particularly if, and we only showed that on one contribution coming in. If you're with a partner or you're married, then if there's double that contribution, it's going to even work better for you.
Yeah. So there's lots of variables. Mike has the tools to enter it all into calculators and formulate what it will look like and to prognosticate the future of it. So it's important to, you know, if you do have a question regarding the size of it, if you can make it work, then reach out to my team. There will be...
Maybe I can answer, there's a few questions in here about starting balance.
Yeah.
Okay. Yeah. The balance is really not the big one. You know, if you're around that 100,000 or just near that 100,000, you are probably getting close to that sort of minimum number that you need. But there are strategies that we can talk about and help you with to get more money into your super a lot quicker.
Yeah.
There's salary sacrifice arrangements. There's other non-concessional contributions you can make. You're not just limited to your employer contributions. So we can give you some general advice around all of that. But it's really comes back to if you've got a number, really speaking to Nathan and his team about what property they can find you that works within that number. So it's not about the number, it's about, and we showed a number of investments here of properties around that 200 to 250K. You know, so it's more about the number of the purchase price rather than the actual number in the super.
It's funny because like I actually, when I set up my self-managed super fund, it was about 2009, 2010. It was just as the GFC was going through, and I remember I had 40 grand when I set it up, and it was like stupid, like people wouldn't set it up for that. But about 45 grand I had in there. Before, like probably about 6 months beforehand, I threw 5 grand in there and had like 50. Right? When I pulled my money out of the super, I had less. I thrown money into it, plus I had less into it, and I questioned myself, like, because I had an income, and I was like, I can just get experience back in the day when I was at my job. And then I realized like I had less money in my super fund, and I pulled my money out and I bought a property for like 40 grand. It was in Cairns, and that property rents for like $230 a week, $40 a week, and the cash flow is quite strong. I bought it cash outright, no debt. And I just kept contributing, and I've got half a dozen that have no loans on, but they're little tiny ones. Everybody's position is different. For me, I've got my retirement sorted. I've got, you know, all that sort of stuff. So it's just more, you know, I've put stuff in there. So speak to Mike. If like I see here, there's one that said for Henry that says, hey, I've got 91 grand in my super fund. Speak to Mike and see if that works. And to see, says he best regards from Victoria, the commie state. So shout out to everybody that's watching.
Yeah, shout out to our Victorian webinars. We feel for you. And no, you can't have Gladys.
Drew asked, what is the deposit requirement for the percentage for a deposit for a self-managed super fund property? It's 30% is the average. There's only a couple of lenders out there that will lend.
Look, ideally somewhere between a 50 to 70% lend is where most of the SMF lenders are at the moment. We find we get a lot better results for clients because we provide you with a very detailed statement of advice that we provide to our financiers here, our Zinger team, and by providing that and showing cash flow and how it works and how we're protecting you, making sure your insurance is there, the lenders are a lot more comfortable to approve loans.
Yeah. And what is the threshold? We've already covered that. Steve asked a good question. Why would you contribute to your super fund when you can use those funds to purchase property outside super and make use of the returns immediately? I might jump into that for a second. Everybody's position is different. So some people might be closer to retirement. They might have a tax liability that they want to try and remove some tax. And that's a good way to help minimize tax. when it's inside a super fund, it is difficult. You can't go and refinance the property and pull out the equity. Once you put the money into the property and pay the loan down, that's it. It's locked away forever, unless you sell that security, because it's a non-recourse loan. You can't rip out the equity. So you're right in saying that, but that's for your position. Everybody's position is different. That's why it's important to get that advice. And I think, Steve,
and look, one of the comments around that is a lot of people that we're assisting in this space have already a property portfolio outside of super, where in some respects they've maxed out at a period, so they don't want to stop buying super. We've had a client recently, exact scenario, where he saw a property, wanted to buy it, and then realised he couldn't because he just wasn't in a position as far as the finance numbers were concerned, highly leveraged, highly geared, which is great because that's the strategy and moving forward. But his wife said to me, well, we've got money in our super, let's buy it in our super fund.
Yeah.
And so he ended up with the property he wanted.
Yeah.
It's not in, it's out, it's inside super. One of the things that is important is to understand that super is a low taxed environment. It's a potentially no tax environment as well. So maxing out that simply means your capital will last longer for you if you're not able to acquire enough properties outside super to give you that income that you need.
It's a supplementary. If you can only buy 10 in your personal name, you can add another 3 or 4 in your super fund. That gets you to the number.
And I think the point you made, Nathan, that it is horses for courses. It depends on your current circumstance. It depends on your retirement planning, your stage in your life where you're at, whether you're 30 or you're 55. And that's why getting a plan that works for you is so important.
That takes me on, depending on what stage of your life. Alan asked a question, at what age do you recommend setting up a self-managed super fund and buying property within? For your information, my wife and I are 30. So, Alan.
Ideal time. If you're 30, Alan, you've been in the superannuation environment for a reasonable number of years. Let's say you started work at 18. So I'm assuming most people tell me how long they've been working for and what their current income is. I can usually within 10 or 15% tell them how much is in their super. So look, the answer, and I'm sure Nathan's covered this off in other webinars. The sooner you get started, the sooner you have. It's very simple. So it's not just for people moving into the retirement phase or pre-retirement planning. It's about accumulating wealth. Most people in this country don't get to their max benefit they can have in super. Most couples don't get to their $3.2 million, and the reason why is they don't start early enough, and they're not attending to that.
They just believe in the system.
Well, the longer you have it in there, the more opportunity. The other thing to consider as well within superannuation, we've now have new legislation that kicks in an increased contribution from your employer over the next 4 years, ending up at 12%. So again, you've got more money going in there. You're giving it to fund managers that don't have your best interest at heart. I would take control.
I've got 2 questions from Godwin. Would you manage an already established self-managed super fund?
I would certainly, interesting talking to an existing client over the last few weeks who had an existing fund, and we've helped tidy things up there. It'd be good to see how it's being managed at the moment, but would put you in touch with OnePath, who are our accountants, who are SMF specialist administrators, and they can have a look at it, and if there are issues there and they can manage it for you better than you can do yourself or your current manager, then yes, certainly can have a chat about that.
And then the other question was, limited banks provide finance to self-managed super funds. Can we refinance the current mortgage of property in a self-managed super fund?
Yes, you can refinance.
Can you?
Yeah, absolutely you can.
I've never heard of that. I thought it was non-recourse, you can't refinance.
No.
I've always been told you can't.
No, you can.
Really?
Okay. So yes, there are.
You learn something new every day, folks.
You can refinance. There is a process, obviously, that has to go through, and we're finding that some people are locked into higher rates. The SMF rates have come down over the last 6 months or so, from high 5s to just under 5%. So worthwhile having a look at that.
Very interesting. I've never seen that happen. It's great. So Aaron asked, how big should your property portfolio be cost-wise before you create a self-managed? I don't think that it doesn't really matter. It's more so how much do you have in your super fund? Is it worthwhile? Like, I think that anybody should have a self-managed. That's where the smart money's at, is you can control that asset base. Like,
it's all about the cash flow. We're particularly concerned in a risk management sense to understand that there's enough cash buffer in the fund to manage things like your costs, your insurances, your property costs, and if something goes wrong. So what we concentrate on is making sure that all of the things that potentially cause you risk in running a self-managed super fund are mitigated to the largest extent we can. And part of that is compliance, part of that is management, part of that is one of the issues around having money inside super is if one of the members died prematurely, then the member account has to be paid out. It can't stay in super.
Wow.
So as a result, if you don't have the appropriate life insurance because you've only got 100 grand sitting in cash, you're 5 years in, you've got 100 grand sitting there, you're just about to buy another property, yourself or your partner dies. When you look at the member account, and that's audited each year, your member account might be worth 500,000. That 500,000 has to be paid out to your beneficiaries and to your estate. Wow. You can put it straight back in if you want, but it has to be paid out. If there's no liquidity, then the property would need to be sold.
Wow.
Okay, so insurance to at least to cover the debt against those properties, not only inside but outside super potentially, is very important because you need liquidity. And by having a buffer, you have time to manage that. You pay your interest costs, you continue to pay all those things. You pay the member account out, and then you have 90 days to roll that back in. But it comes back in as, there's two types of contributions in super. There's the one that comes from your employer, and that's called concessional contributions. And it gets taxed at 15%. As opposed to your marginal rate. It's beneficial, it's concessional. However, if you get a payout like that, it comes out with what would have been all of your concessional contributions, effectively. But when you put it back, it's treated as non-concessional. You don't pay any tax on it.
Okay.
So again, there's lots of moving parts. That's why we recommend you get advice.
Ashley wrote here, sorry if I missed this already, if you have the property in your super, do the banks look at that and take that loan / cash flow into account if you were buying a principal place residence?
No.
It's non-recourse loans. Those loans are limited to the super fund. The servicing of the super fund is coming from the contribution, so it's totally separate to your personal.
It's a regular process, isn't it, Nathan? That outside super people are cross-collateralizing, and you've got a portfolio here of total, and they want to take the whole lot into consideration. The money's inside your superannuation, the property's inside, and the loans are completely separate.
Steve asked, so if we can refinance in our super fund, what is the best process to do? Talk to our financial advisor.
Correct.
I'd probably suggest, Steve, have a chat with Mike. And Mike works very closely with Rose Zinger. That's how I met Mike, was through Rose. So if you want to reach out, I'll get the team to hook us up. But if you don't, just speak to Gemma tomorrow.
That's a phone call, Steve. Happy to take that and look at your current circumstance.
Michael asked, and Michael here, not Mike here.
Yes.
I'm 31, have 50 grand in my super. Would it be better for me to start a self-managed super fund by making extra contributions, or continue with my regular property portfolio? Because there's two answers to that.
Look, the first one, probably look at your circumstances of whether salary sacrifice could work for you. You can make contributions up to $25,000 as a concessional contribution, which is your salary or your SG and sacrificing some of your salary, and we need to look at that to see whether that works with your personal cash flow. You can make what's called non-concessional contributions, and you can make a contribution of up to $100,000 a year, and you can even bring forward 3 years of that. So a lot of our strategies with some of our clients that have got equity outside of super, to convert it into an environment where it's non-taxed, we can bring forward with a husband and wife up to $600,000 of a contribution in 1 year.
Yeah.
So there's lots, again, moving parts. And again, the advice, I think, as to what's best for Michael would be to have a conversation with you, Michael, directly.
Cool. I'll answer 2 more of these and then we'll get back to the slide deck. One is just, I'm going to answer it very quickly. Matthew asked, I have a mate who put all his SMS into crypto. Are you finding this to becoming more common? My initial thought.
Hi, Matt. I know Matt.
I do, yeah.
Hey, Matt.
So in my personal viewpoint, I never go all in on anything. So, you know, I like to have a part of liquidity. I like to have good growth. It's riding back highway. For me personally, I wouldn't go all in on something like that. I've had heaps of mates go, why don't you sell something? Why don't you do this? You know, crypto is volatile. I've seen a lot of people that actually, this is firsthand, I've had people calling me in tears that had like 200 grand in their super or whatever. And the last crypto bull run, they went to dodgy sort of financial planners that just helped set up the funds, and then they did all these bullshit things with ICOs and whatnot, and their super funds are 200 and now sitting there at like 1,100 bucks, 1,400 bucks, shit like that, and they're completely wiped out. This is very volatile stuff. Put the money you put into the pokies in the crypto, put 500 bucks, put 2
Stop
grand,
smoking,
put
use
10
that.
grand, whatever, put 50 bucks a week. Don't put your whole super fund in. There's my non-financial advice. Don't give a shit who's listening, because that's very sensible advice. What would yours be, Mike?
Yeah, you know, the problem, look, I suppose the reason we're here talking about this process is that if people don't believe in this country how stable property is, just go back 18 months and the doomsayers have said with the worldwide pandemic that property prices were going to crap themselves in Australia. Not only did they stay stable, not only did most people who own property have really no issues with tenants paying their rent, the property prices have gone up. We've just had CoreLogic this week tell us that we've seen in some places around Australia unbelievable growth.
Yeah.
Look, I'm not ever going to tell you what to do with your own money, because it's your money. But at the end of the day, there's no, I won't say there's no get rich quick schemes. There's always the odd thing that pops up. But get a plan, understand where you need to be, put the things in place in sensible, stable, secure investments, and you'll end up where you need to be without any stress.
So I'm just making notes of something here. I'll send a couple of people to my team. Specifically, Nikki here just said, we're self-employed, had our best year in 13 years. Congrats, hope you're doing well, Nikki. We're in a position to buy in a self-managed super fund now and need advice on extra super contributions for this end of financial year. You've got a short window.
Nikki, if you've got current super funds set up, there's unlikely at this stage that you would be able to establish your self-managed super fund in time to get those contributions in this year. So my advice to you would be very simply, make whatever contributions. I run a small business as well. I understand how it works. We're getting to the point where do we make extra contributions? I'm at an age where getting money into super is important. So you'd make those contributions into your existing super funds that you've got. As far as the self-managed super fund, we can get that underway, and the longer you leave it in that other fund, the higher chance that you're not in control of those investments. So we can help you get that transferred. But to get it in this financial year, probably the best place is to put it into your existing super fund, and we can set the self-managed up and get it rolled over as quickly as possible.
Godwin said, I'm keen to get in touch with you guys and streamline my self-managed super fund. So there'll be an email up later. Just reach out to my team and they'll put you in touch with Mike. So just
they actually have control of my diary, so they can actually book a time for us to talk. Happy to do over the phone, a VC meeting. If you're in Sydney, happy to do it face to face.
Cool. And yeah, with it, yeah, just when you send the email over through to the team, just write, I want to catch up with Mike and have a chat with Mike. So what's happening here with the slide deck?
Oh, there you go.
We're going backwards a bit fast here. Where are we? Next one.
Just slow down.
Slow. So why a strong foundation? I always talk about a foundation property portfolio, but why do you need a good sort of financial underpinning to your super fund?
Yeah, look, there's 5 key areas that we go through with our clients, Nathan, that really affect the operation and the, I suppose, decision to set up a self-managed super fund. Firstly, the setup and management is very important. There's some questions that we need to understand with your current circumstances to make those right decisions.
Yeah.
The management is extremely important. We highly recommend. I get very nervous with any client that says to me, I'm going to manage this myself. That's because, not that I don't think they may be capable, there's lots of moving parts, and it really is a specialist area for people to make sure you stay compliant. If people don't understand, superannuation has a huge carrot, and it's all to do with tax, but it's got a bloody big stick as well.
Yeah.
And self-managed super is even worse. It's administered by the tax office. If your fund is non-compliant for any period of time, you may get a slap on the wrist the first time. If you do it again, then there is an opportunity for the tax office to tax your whole asset of the fund at 50%. So that's the big stick. Do it right and you get all the tax advantages. Don't do it right and manage it, then it becomes a problem. So setting that up is most important. There's the financial considerations. Do you have the cash flow? Do you have the contributions? Do you have the starting balance? So that's what we assess for you, and we use the calculator to do that. Compliance, I've managed that before. If you don't have the right compliance, we've got people walking past.
We've got our finance team are still working, right? You guys with your loans, they're getting written at 8:30 at night, they're walking out the door. So
obviously, investment is a big one. When you set up a self-managed super fund, you effectively have a cash management account that you as trustees have access to. You can go and put it in anything. At the end of the day, it is your money. We can't stop you, but we would certainly give you a lot of reasons as to why you should be taking note of the risks involved of some of these other areas. And the last one is exit and winding up. Very important to understand what would happen in the event of a disability, a premature death, a husband and wife. The 33% of self-managed super funds are wound up because of divorce. So that's okay. We don't always have to live with the same partner forever, but at the end of the day, understand what's going to happen up front if something like that happens.
And the members inside that super fund, so you can have up to 4 people?
Have up to 4 at this point. They're looking to change that to 6.
6, cool. So you could have up to 6 people in there. You might be mates with your friend today, but will you be mates with that friend 10, 20, 30, 50 years down the track? You've got a brother and he's got a wife and you hate the wife, like, are they going to be together? When you were going into, like, people just walk in, like, people get divorced all the time, right?
Yep.
And like, you go and get married, you go get divorced, so what, whatever it is, people doing it for right or wrong reasons, but they don't look at the key fundamentals of like down the track, like they're compatible today. When you're hopping into a property purchase or when you're hopping into a super fund with someone else, you are essentially marrying that person for a later part of their life. And your thoughts?
And again, look, one of the keys to that is getting the right structure up front. We recommend our clients always set up the super fund as a corporate trustee, or so you'd have a company that is a sole purpose trustee company for the super fund. Why is that important? In that circumstance where either a partner dies prematurely or there's a split, companies through ASIC can operate with one director. So you can be a sole director, trustee company with one member in the super fund. If you had individual trustees, you can't be an individual trustee.
Yeah.
So if that person was to leave the fund, either of the ways that I described, then you'd have no choice but to wind the fund up. Now, that's not in the best interest of you building a property portfolio.
In and out costs.
There's all of that. So again, structuring it correctly is very important to make sure that we cover off on all of the things. And that's really what we do as an advice business. We concentrate in all of those areas and let you make the decisions of where you want to invest. And most people who are joining us tonight are looking at property, and that's great from my point of view.
Cool. And I've seen a lot of questions coming through. We finished on this slide.
Yeah.
I've seen a lot of questions coming through about people prematurely putting money into their super fund, so like pulling equity out of their property. As Mike's saying, it is a tax vehicle. If you're pulling equity, you're paying tax in there's elements there.
Correct. It
could be or may not be the best suitable thing, but it's important to discuss with Mike about planning for that, because if you're pulling out equity from your personal name and you're putting into a super, there is tax implications if you go over the 25 grand, which you'll be paying extra tax on, but you could use that equity in your personal name to buy more property and pull equity again. So.
And again, and this is why it's so important to understand that the advice is always delivered specifically around what's in your best interest. And if it's in your best interest to, because you have a drawdown facility or have something else that you can put that into super, then the reason you're putting in the super has to be identified. You don't just move it from one place to the next and really get no result. So if you're going to do that, it must be for the purpose of having a larger super fund that allow you to get into property, or in particular, if you're doing that, you're putting it in a non-concessional environment, which means that there's no tax on the way in, and it's tax-free while it's in there. So we look at all of that and come back to you with some very, very, what I'd call, easy decisions to make, because the numbers will speak for themselves. We'll say, no, you're better off doing it over here, or you're better off doing it over here. And that's why we do the analysis in the cash flow, because the numbers speak for themselves in that regard.
Cool. And seeing there's lots of questions coming through. I'll get back to them later. The fundamentals of we talked about the foundation beforehand. Look,
it's like anything, and draw the analogy with property. Of course, property stands the test of time so long as it's built on good foundations and it's quality. So a quality structure, making sure you get good advice, you understand all the implications around those 5 key areas that I mentioned, means that you have the best opportunity to ensure that, and things don't go well for everybody. Things happen from a relationship, from a financial point of view, job loss, tenant loss. There's a whole range of things, but if we understand that up front, then we can put in a plan that would allow you to have the least impact of those things, and that's what a risk mitigation plan should be about.
What a
perfect segue
slide.
Look, the thing, and I suppose the principle that we operate on is there's only 4 ways to mitigate risk. You can accept it, you can avoid it, you can transfer it and reduce it. Accepting risk may be that you don't want to take out insurance, you don't need to take out insurance, or you accept if something goes wrong, you're going to take a financial hit. That's probably not the best option, but it is certainly an option. You can avoid it. So to avoid any risks in this space is don't set up a self-managed super fund, don't buy property, don't do anything. That's avoiding risk. The problem with the outcome of avoiding risk is you have to take some risks to get ahead. So understand what they are and be aware of them and deal with them, and that's what we help you do.
But you risk, if you don't set up a self-managed super fund, is that you've got it in an industry super fund, and then inflation is going to be eating away at that.
And look, the biggest risk for me has always been a timing risk with having your money in superannuation managed by somebody that doesn't care when you retire. And I've been through 87, I've been through all of these things, and I've had many financial planning colleagues of mine deal with clients whose retirement has been absolutely decimated because they were trying to squeeze every last bit they could. They're going to retire on the 30 June in a year, and in April, the market craps itself, and all of a sudden, the retirement that they thought they had, the money they thought they had to live off, 20, 30, 40% of it's not there anymore.
Yeah.
So by having a self-managed super fund and having it in a stable investment of cash and property, I can not guarantee anything, but I can guarantee that you're not going to have that issue we just described happen to you.
Yeah.
Transferring risk is about making sure where you can, you ensure that you have your personal insurances, your building insurances, your tenant insurances all in place. So when something goes wrong, and we had a message from one of our clients there earlier, that's exactly what we've done for Matt and his wife. We've got him set up with the right insurances. He's now setting up the self-managed super fund, and we go forward with confidence, knowing that should something go wrong, he and his wife will be taken care of.
Yeah.
The other one is to reduce it. And sometimes reducing is just about maybe not biting off too big a chunk to start with. Get used to the whole process and make it work.
I need to go to the gym.
I think we're done.
No, we're not done yet. But like, I feel like I need to go to the gym nowadays, right? If I went to the gym and pushed it like I used to,
you get sore.
I get sore. I rip the
Then you don't do it.
I fell over the other week, I slid over and smashed into the wall, and I had this big lump on my arm. I was just playing with it at the moment. So, you know, if you're pushing yourself too hard, you will screw yourself up too. So, you know, if you will go to the gym for the first time, you'd start with one push-up, you know, one sit-up. It all starts with an action. So there's no race to the end as to, you know, overdoing it. So lots of questions coming through. Keep the questions, we'll get to them shortly. Income protection, tell us about that.
Yeah, look, one of the things that's happening in the financial services space is that the regulator, APRA, basically started working with all of our insurers in the marketplace about 2.5 years ago to address one of the fundamental issues. And one of those is that the disability product markets, which is your income protection and total and permanent disability, over the last 3 years had losses of over $3 billion in that industry. Higher claims, mental health is a big one.
Yeah.
But as a result of that, we've seen some changes over the last 18 months or so. Big change coming up in October. If you don't have income protection, if you do not have income protection at the moment, and some of you may have it within your super funds by default, you will not be able, and if you don't have it, this is the big issue. From the 1st of October this year, there will be a brand new disability income product that every insurer needs to put in the marketplace, which means you would only be able to get a benefit for 5 years. In the 5th year, the underwriter or the insurer has the right to re-underwrite you going forward.
Wow.
So that's a massive change to the industry. And the effect of that is that it will have consequences from a cash flow. The other thing is that you can currently insure 75% of your income. That's going to be reduced after 2 years back to 60%. So getting advice around how to put together the right portfolio to make sure that we have a process within our business we call a fully funded estate. So my job is to assist you, working with Nathan, to get you to your fully funded estate, which is the best you can be. If something goes wrong along the way, we just want to make sure you still get there.
Yeah.
And with the changes to this disability product, we're certainly recommending to people, if either they don't have it or they currently got it or they're in their super fund, we need to make sure we review it to get you the best possible outcome.
Yeah. Once again, speak to Mike. How to calculate financial risk?
Look, one of the frustrating things for me is that I say to all my clients, the most amount of insurance that you need personally should be the very first time you meet me. Why? Because as you're growing your personal wealth through property acquisition, through other means, through capital growth, through superannuation growth, your net asset position is growing.
Yeah.
if your net asset position is growing, then why do you get a statement each year from your super fund with them increasing the amount of insurance that you've got? I know Nathan loves a conspiracy theory. I don't mind one as well. The conspiracy theory there is that you've got indexation on a life insurance amount that you don't need to have. Your insurance amount should be decreasing each year, not increasing, and it should be decreasing in line with your asset growth. So that's one of the things that we need to understand, what constitutes the right level of cover. When I do a review with client, 99 times out of 100, they've got not the right cover, they're paying too much, or they've got more cover than they need. So I'd encourage you to, and again, we have a calculator that we use that we can assist you with to say, here's your numbers, this is what you should have. If you have anything less than that, you're underinsured, and it goes back to you manage that risk.
Yeah.
If you want to take it on yourself, that's entirely up to you, but make sure that you've got the right levels of cover. Unfortunately, what I find with most people when we get to this point, we're looking to roll over their current super, their current existing insurances are typically not adequate.
Yeah.
And there are risks and gaps there.
Cool. And then now to the questions and answers. So yeah, with it, I've got here, actually you've got a thing here with your email. Normally,
Yes.
we normally would have it come straight to the admin at B.Invested, so either reach out to, if the people are going to email you directly.
Make sure you let me know you're part of the webinar.
Yeah.
Because that constitutes you getting some free advice from me as well.
Yeah.
But we've got to make sure that the B.Invested team's following you up.
Yeah. So with it, you can either message Mike directly, or you can get the team to.
Honestly, guys, the easiest way is to come back through the team at B.Invested.
Yeah.
They have access to my calendar and they can just book them in
straight away.
Yeah.
So with it, so questions coming in. So the email address would be admin@binvested.com.au. Sarkis asked, is this show going to be on YouTube? No. I noticed also you said here, I've been listening to your YouTube channel for the last few years. Love of it, appreciate it, mate. First time on a webinar in my life. Just want to ask you about apartments. Do you think the prices are going to be inflated like the house prices are doing at the moment? Yes. What I'm starting to see across all states and cities is that, love some water.
Yep.
Is that the prices are being inflated. A lot of the land developers are actually out of land. A lot of those salespeople from the land estates are actually going to be out of jobs because there's no more land for them to sell in the current sort of englobo sites. So these big, large corporations have been buying the land in the capital cities, doing big developments. You know, the Lend Leases, the Stocklands, and all those sort of guys. But there's no new big estates that they're ready to build on. So there's nothing else for them to sell. But they've got lots of sites that they've acquired that they can build, you know, 20-story towers on, and the cost of goods to build those things are going straight through the roof. And if you're looking at $1 million unit or you're looking at a $300,000 unit, suddenly that old unit gets sucked up. Well, my hands aren't even on here today, but we get sucked up in the vortex with inflation. So the cost of bricks gone up, the cost of concrete, the cost of steel Rio, the cost of copper pipes. Copper has gone up 2.5 times this last year. Iron ore's gone up double this year. Lumber prices, so timber's gone up 6 times. The cost of building has gone up 50%. You know, just in the last 12 months. So I do expect to see that as well. I need to get Mike to speak with my old man. He won't listen to me.
Maybe I should get you to speak to my wife. She doesn't listen to me.
With that, Jono,
maybe Jonathan, we have a chat first, and you tell me the circumstances, and that way I go in with the right way to manage that. Sorry, I've been there and done that before.
Get Jeremy to book you in for a chat with Mike, and he can
absolutely
have a chat with you. So. Wayne, hope you're doing well, mate. Nathan and his team purchased 2 properties in our super. Should we review this to make sure we are all go in the current market? Yes. We should have a catch up, Wayne. It's been a long while. It's been, I think, about 18 months. My office was like really a mess when you came in last time. Things are very different in here now, so it's been a long while since we caught up. we need to catch up. We need to review your position, both on my side and also from Mike, just to see where you're at. So either just reach out to the team, hit me up, and I'll organise a chat for both myself and for Mike. I think there's one or two questions here. Actually, no, I think we've answered all along the way.
From Adam there, the 20-year. Let's have a quick read of that. I'm self-employed, another couple of.
No, there's one we answered that. It was about withdrawing equity for the.
Oh, right. Okay.
Yeah, we've already covered that. So yeah, I think that's all up. So if you want to do have a chat with Mike, good solid financial planners will charge you. It's like a taxi meter. They have a clock that ticks. Getting a chat with Mike is just due to the fact that you're part of the community.
Yep.
And let Mike know. So either you reach out to him directly or email the team at admin@B.Invested.com.au, and we can put you, in the diary for Mike directly. So.
Look, the part of that process, Nathan, is to by us taking the time to answer some of your questions, it puts you in an informed position to make a decision as to whether you want to go ahead. I'd rather spend.
It's the right thing.
Yeah, exactly. Whether it's the right thing, and I'll be fairly blunt. I'll tell you whether it is or it isn't. But if it is, then I'll explain to you what the next steps are and how we go together. Go together from there.
So with Mike, there's less than 3 or 4 planners that I've ever liked and trusted over the years, and it takes a lot to impress me. And good flow and understanding of positions and holistically looking at portfolios is very important. That's where Mike comes in, and has been doing great things for our investors. And I appreciate
absolutely.
The work you've been doing, and I've certainly had good feedback from everyone as well. So thank you, and keep it up. So, on that note, guys, we're out of questions. We've been with you for 1.5 hours today. I'm trying to keep these sort of concise to timelines. So we'll catch up soon. Stay safe in the meanwhile. Keep being awesome, and
cheers.
how we can help you.
Look forward to chatting.
Bye for now.